All right, check, check, check. What's up? We should be live right now. Give people a minute to log on. Let's see. We get in here. Where are we mapping out? I'm still experimenting on this thing, guys. So y'all got to bear with me. I'm testing out a new streaming service to try to hit multiple lives at one time. So hopefully this should be going live on Instagram, YouTube, and Instagram, YouTube, and and Facebook all at the same time. So that's what I'm hoping is happening, but I don't know for sure. So yesterday I think I hit YouTube and I hit Facebook, but it wasn't on Instagram. So all day, so I are trying to make sure. Okay, so now I got an echo. Okay, so I did. So Instagram is on too now. So that's cool, but I'm gonna have to turn that down so I can hear myself talking. Okay, well then cool. If we got all that, get the captions off of here. And let me see. We're gonna step this all the way up though. Now that I see that I think I'm operating this loud and clear now. So it just took a minute, jumped on there. So what's happening? Hope everybody feeling good. Welcome to the first official. Why is this thing not the first official deep in the money? I'm going live deep in the money. So we can talk about the markets, talk about what happened. Y'all see me looking up. I got another screen right here. I'm kind of looking at. So let me put it right here so I can look at it over here and split that. Not there. Over here, so I can look at it. So I'm looking up. Or you know what? Let me close it over here. Get that situated right. So this ain't gonna be nothing heavy today. I'm gonna just introduce the marks, talk about the market, and kind of introduce this little live section. I'm gonna just come in and kind of recap what happened in the market today, every day that I get on here, just to give y'all a little insight. Because at the end of the day, um, I want to see you win. I want to see us win, and we've been getting left out of. We've been getting left out of. We haven't had our seat at the table, and we've been getting left out for way too long. So it's time for us to pull up, get a seat at the table, and we're gonna have to strong arm them for our reparations because they don't want to give us the reparations. So my belief is the best way you get reparations is to get out there and get them yourself, and that's the stock market is where you're gonna get your reparations. Because at the end of the day, power in America comes from owning land and owning businesses. You got to have ownership. You got to have ownership because don't nobody care about nobody except for the people who have ownership and the people who control everything, control all of the power and resources. Those are the people who have the say so. So you can protest all you want, you can vote all you want. At the end of the day, though, it's whoever you when you really hear it, if you pay attention to the words you hear, you'll hear them all the time talking about, oh, we're lobbying, or we are lobbying for this, lobbying for that. What does that mean? That means the people with the money, the people who call the shots, pull up on the politicians, and they're like, these are our demands. These are the things that we want. And that's how America really works. America really works through, you can put some pressure with a group, but the groups who have really all of the power are the lobbyists. And lobbying comes with having the bread to be able to put people in office who are going to serve your interests. So that's just my personal opinion. And so with that, I'm going to talk about, I want to talk about how the markets went today, but also how that influences what's going on in the country. So, my notes at. Let me look right here real quick. This is cool. I like this way we can get on here, chop it up with my people. So, let me see. get on here. Let's see. Now I'll go back over my notes from earlier. I jotted down some notes of some things I wanted to make sure I talked about. I'm only gonna be on here for about it's an hour time limit for anybody who's thinking about doing this. An hour time limit on Instagram. I'm gonna give y'all probably about 20, 30 minutes and just update you on what happened in the market today. But what I really wanted to talk about was I read an interesting report yesterday. I was looking at the unemployment report, and it was really interesting because what they said was, and I'm looking, my camera is right here, but my space is right here. People looking at my face, so let me look at the camera instead of look at this. So what it was talking about was California has laid off 70,000 people. The big boys, the Amazon, Meta, Microsoft. No, Microsoft is there, so it wasn't Amazon, Meta. I forget who the other big one out there. Google, Amazon, Google, all been laying people off, and that's because of the transition to the AI economy. Make no mistake, we are in a transition right now from a regular. Well, we went from the industrial economy to the information economy to the digital economy, and now we are going to like the next level or the transition from just not just the digital, but to the information economy. That's right, information, and I like to say information. Data is the new gold, and information is the new oil. So if you think about it, the reason why you have the reason why you have your Instagram for free, your your Facebook for free, and your YouTube for free, and your Twitter for free. If you ever stop to if you ever stop to think about it, the reason why you have all these social media services for free is because they want to gather your information. They're gathering information. You are the mark. You are the actual product. And so what happens is those social media services sell your information, right? So think about it like this, and this is why Meta is such a good investment. So Mark Zuckerberg, he builds Facebook, right? He gets millions of people. I think right now, billions. I think right now, I think it's 3 billion across all his platforms. I think he has 3 billion. Don't quote me on that. I had to tell. I think about 3 billion people on all his platforms, and some of them, of course, is duplicated. But anybody, he can go to anybody who's selling any kind of product or service and say, I have your customer, whatever kind, I don't care what your product or service is, I have the customers for you. I have the people that want to buy your stuff that don't even know they want to buy your stuff. So everything that you look at, everything, they're gathering information on you. Everything that you look at, everything you put in your box, everything you buy, they get all this information. It creates a profile on you. So then when somebody wants to advertise with Meta, they ask them, okay, what kind of person you want? And they give you like what's a list of the important keywords, important things, and then they try to connect you. It's kind of like a love connection, right? Or a dating app. And it's pairing you with the person who with the business or the person who's selling the product. So you actually become the reason why you're getting this services for free is because you are the actual product. So anytime you're not paying for something, you got to realize ain't nothing for free. There's a price for everything. I like to say what they say in and 7 Habits of Highly Effective People. What he said was there's a price for everything in life, even your own success. And so when you think that you're getting something for free, if you're not paying for it, then you're actually the merchandise. So just know that. And so they're selling your information. And that's why the ads that pop up when you look at stuff are based on what you look at and what the algorithm is saying about you and what they have in the database. So that being said, you got to understand how much money is in information right now because we are making this transition, like I said, into the information economy, where they not only now they're not only using your information to sell to sell to all the different advertisers. Now they're using your information to program AI. And that's why I am so intent on teaching y'all how to invest in artificial intelligence and understanding where the money is, because this is going to be 14.7 trillion is what they're saying. 14.7 trillion with a T. Let's just call it 15 trillion by 2030. We almost at 2026 right now. And if you want to know where the money is to be made, all you got to do, you follow where the money is being spent. And right now, the hyperscalers, I want to say, they're up to almost $600 billion between Google, Amazon, um, uh, Microsoft. I think just between those three, they're up to almost $600 billion of what they're spending. At the same time, they laying people off though. So you got to understand, AI is going to displace a lot of people, and you're going to have AI skills in this new to be a part of the new workforce. But not only do you want to have AI skills, you want to be invested in AI and have ownership. So that's what I got. I got a challenge coming this weekend called the AI Money Machine, the AI Money Machine Option Trading Challenge. I think I'm gonna change it to the 200K challenge because the whole goal of it is to help you get to that top 10% in income, which is about 100 and I think it's $182,000, puts you in the top 10% of income under household incomes in America. So my goal is to get a group of people, train them on how to trade options, investing into artificial intelligence, and get them over get them over that six figure hump. So they can get on the fast track to financial freedom and control their financial destiny. So let's talk about where we are with the markets today, right? Because there's a lot of I've been getting a lot of questions and everybody, should I buy this? Should I buy that? In my opinion, and it's just an opinion, um, the markets are getting the price of everything is getting kind of expensive. There's no real deal. There's no real deals in the market right now. So you gotta be careful jumping in when markets are hitting new highs, and especially when they've been going. You think about it now. Normally, my investing thesis is the best time to be invested in the market, and I like to use these days as markers. Now they just guidelines, right? So I like to go when the setup is right. Halloween to Easter is the sweet spot to be invested in the stock market. That's usually when you see the biggest run. That's when I've made my most money. This year, though, it could be a little bit different because we've been running since April. We had an April bottom instead of what will usually be a September bottom, right? So I don't know if we are ahead or behind for the next cycle. Right now, it's looking like we could be ahead of it because we're expecting more interest rate cuts. Um, I'm expecting everybody, not just me, everybody's expecting an interest rate cut for another cut this month and then another cut in December. But that might already you have to watch out for those because that could that could already be priced in too. So you always have to have a plan. And that's the thing is you start getting all this information and it gets hard to block out the noise. That's why it's important that you have a trading plan. That's one of the first things I learned was plan your trades and then trade your plan. So you hear all these people talking and they'll be running after they 1 minute they chicken 1 minute. I like to say 1 minute they chicken. You got Chicken Little on this side, and you got the boy who cried wolf on this side, right? So what you really have to do is block out the noise and then focus on the fundamentals first and then the technical second. So the way I was taught and where I lean is about we make our decisions, and at Rich Forever, the way I train people is we make our decisions 75% off of fundamentals and then 25% off of the technicals. So the fundamentals tell us what to buy, and then the technicals tell us when to buy, when to get in, when to get out. And so if I look at the market, and let's start let me see. You guys see, I'm gonna try to get extra smooth here in a minute. See if I can share my screen. If I share my screen on Facebook and Instagram at the same time, that's gonna be done. So one of the things that I do every day is when I come check the market. Let's see, can we get you over here? Um, no, it didn't go over there the right way. So when I come check the market every day, and this is what I want y'all to start doing every day. When the market closes, I look at what the market actually did. I want to see how much up or down, how many points it went up or down, percentage wise, and then I want to see if the volume was up or down, and then how close that was to the average daily volume. And then I want to see how many stocks went up on volume and then down on volume. And I want to compare. And that kind of gives me the reason I'm doing that, the reason behind that is that tells me if the Bulls or the Bears won the fight that day, who's really in control. And it's a sign when you see high volume, because it's not so. It's one thing to have an up move or a down move. It's another thing to have an up move or a down move on heavy volume. That heavy volume is a sign of institutional buying or selling. And so you have more conviction or confirmation on the up move when you see high volume, or more conviction on a down move when you see high volume. So today the market went down. It went down. Nasdaq is down 67 basis points, um, but the volume went down. And so if the volume goes down on a down day, that is a sign that you're still in that you're in a strong bull market. Okay, that makes sense. That is a sign that you're operating in a strong bull market. So you don't panic off of down days on low volume, right? But I also like to look at what Market Search calls stock action, which I want to see how many of the best stocks went up on volume, and how many of the best stocks went down on heavy volume. So today we got 141 stocks that went up on heavy volume, and we got 373 stocks that went down on heavy volume. That's 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 better than 2 to 1. That's almost, what is that, about 2.3 to 1. I got to calculate around some more. So we see, y'all with me on Instagram? Okay. Y'all see me up there. Y'all with me on Facebook too? Okay. So if we look at 373 over 141, 2.6. So if you think about it, um, stocks are down 2.6 stocks. 2.6 stocks were down for every one stock that was up on the heavy volume on the good stocks. And then the other thing we look at is the number of stocks breaking out. Today, there was no stocks breaking out. And then how many stocks are near pivot? 7 stocks are near their pivot. So I track those numbers. I go look at them. So one of the services I use, and when I look at that, that tells me, not a great day, and it tells me that this market is starting to slow down. Now I don't get another distribution day because the volume was lower, but we are already up to 4 distribution days on the Nasdaq and 3 distribution days on the S&P 500. Okay, when you get to 5 to 6 distribution days on the S&P 500 and on the Nasdaq, that's a sign that the market is topping. You'll hear people tell you that you can't time the market. You can't. You can time. They can't time the market. You can time the market. When you start to see you start to see distribution days running up. That is the end. That is the beginning of the end of a bull market. You're gonna see a pullback. Now that doesn't mean we're gonna get a bear. You either see a correction, and that correction is either going to bounce and go back up, or it's going to continue and turn into a bear. It's really all of this is way simpler than people have led you to believe. All of this is way easier, bro. I'm gonna keep it one with you. You just gotta know where to place the pieces on the chessboard, and that's what we're doing. We playing chess, not checkers, when it comes to these markets. So, um, so when we look at the stock action today, the stock action was bearish because they outnumbered the bulls outnumbered the bears 2.6 to 1. I look at it. Now, when I look at the psychological indicators, and this is me peeling back the curtain some more, I'm giving y'all all this. Why am I showing off? Give me all this game. Well, really, I'm giving it to you because I want y'all to win, but also just to really just establish who really about. I give y'all like little nuggets that help you. All these little things that stack the odds in your favor and help you assess the market to make your decision. I'm trying to teach you how to fish. I know a lot of people be having these things. They throw stocks out there and give you. They don't know what they have all these different services, but they don't really teach you how to fish or tell you why or why not, or how to use the information they're giving you. Let me say it that way. So, if I look at the CBO market volatility index, and I see today it's at 16.7. So what does that mean? 16.7. Everything when we look at the stock market has to do with highs, lows, and averages, and then where are we in comparison to the high or the low? Does that make sense? Where are we in comparison to the highs to the low? Right. So we want to look at that range. So if you start off and I look at the VIX, I see that the 12-month range for the VIX is 12.7 is the low, and then 60.1 is the high. Now, if we are at 16.7, what does that say? Are we closer to the high or the low? We're closer to the low, right? We're really close to the low. And that's measuring uh, the VIX is a measure of volatility, or they call it fear index. So if you think about, just simplify it for you, boiling it down, we look at the VIX, we got a low VIX, then that means that investors are pretty calm, that there's no real panic in the market. Some people would say that might be, we might be too calm. But right now, there's no panic in the market, and everybody's pretty calm, and that's why we have a 16.7, almost near the lows. And so you got to be careful when you look at when you look at when the VIX is low, because that kind of sometimes these people are getting too comfortable. Okay. Now the other thing, follow that up with, look at the ratio of the price premiums and puts versus calls. Same thing. So the range is 0.31 to 2.91. And so think about what that's telling you. So right now, 0.37 is what the ratio of price premiums and puts versus calls. So that's telling you that people are buying a lot more calls than they are puts right now. Why? We're comfortable. Again, here we go. Everybody's comfortable. Everybody's bullish right now. And so when you see a really low put call ratio, then that's another signal that a market is starting to get top heavy, and that we may be getting near a top, or at least that people are comfortable. People are buying. Nobody's really buying puts right now. Nobody's hedging for the market to go down. In fact, we see that it is about 3 to 1. Same thing, about 3 to 1 call calls to puts, right? Um, and then the one that I pay the most attention to, and this is a simple, easy one, right? I look at the price to earnings ratio um, on the Dow. It kind of tells you how how much money people are paying. So if you look at what price to earnings is the price of a stock divided by the earnings per share. And so if we look at the price to earnings, a PE ratio tells us how much we are paying for $1 of earnings or $1 of profit, right? So if you think about it, if you see a price to earnings ratio of 25, then that means you're paying $25 for $1 of earnings. So that's what that PE means. And so that's how you compare. PE is a quick back of the envelope way to compare what you're paying for companies, because all these companies have different amounts of shares, different prices. You might see a stock that's $100 a share and a stock that's $50 a share, and you think immediately that that stock that's $50 is cheaper. It may be cheaper on a price basis, but let's say that $50 stock only has, let's say they only have $2, they only have in earnings. So that $50 stock, maybe with $2 of earnings, if you divide price, which is 50, and then earnings, which is 2, then that's going to give you a 25 price to earnings ratio. Now let's look back at this. This other stock is 300, and they have earnings of, let's say, let's say 150. Make it even. Make it 150. That 300 by 150 would mean that they have a PE of 2. So you would be paying $2 for uh you would be paying $2 for $1 of earnings. I gotta sit this on. Let me get these people on silent. They got a hold of my number at the telemarketers have been blowing me up. It's crazy. But anyway, so we want to look at the PE, and the PE helps us. PE is kind of the way we got is the most popular valuation metric it is. Everybody looks at the PE and it's like you look at low PE, high PE, and if you're a value investor, you're gonna base a lot of your buying decision on the price to earnings ratio. I use it to try to make an assessment. I like to compare the price to earnings ratio over the last 12, the range over the last 12. Remember, I said you want to go the high and the low, so I want to look at the range over the last 12 months and then the range over the last 5 years. I get over here on this metric. So when I see a price to earnings ratio, right now the price to earnings ratio is 24.9. And then the low for the last 12 months is 20.1, and the high is 27.1. So you can see it's right about in the middle. It's not pushing to the edge yet. More upside. And if you look at a chart, you can see there's more upside, and then um, it's not a wild evaluation where you just think that it's too much. So you want to look at your price to earnings ratio. You want to compare, and so it's right there in its middle range. Because if you think, what is that, 27 and 20? So that would be what, 2350. So 2350 is at 24.9. So it's just a little bit above the halfway mark for the last 12 months. And then if I look at it over 5 years, the range is 15 to 30. So for my long-term investors, a bigger perspective is still right there. Um, Now it's a lot closer to its 5-year high when we look at it, when we when we back up, take a 30,000 foot view, we see it um, getting a lot closer to its highs, but it still has plenty of room. It still has plenty of room for some more upside if we're looking at it on this basis. Now, what I will tell you is If it wasn't for artificial intelligence, I think we'd be in a recession already. Because when I look at when I look at most of the major sectors and how they've performed, the industries that how they performed so far, you can look and see. So when you look at the industry groups, share my screen with y'all in a second. Let's see if we can push this over here. See if I can I get this on? Mm, hold on. Where's that list? I want to see. Okay. That is not. Okay. So let me see if I can share this guy with y'all. Share. Y'all see that? Y'all see that? I don't know. It's probably gonna be too small on y'all phones. I don't know if you see it on my phone. But um, if we look at how the different industries have performed year to date, um, you see aerospace up 33% year to date, agriculture 4%, and let's do it by let's do it by day. If I can get that okay. So year to date, look at what we have here. Look at here. Surprise, surprise, surprise. The best industry year to date has been the mining industry, gold, silver, and gems. Why? Because when um, when people are worried about the economy, there's usually a transition to gold. And you've been seeing a lot of money go into gold and to Bitcoin because people are worried about the dollar and because of all of the tariffs. But this is a conflict, right? Because I just said 5 minutes ago that market volatility was low. So market volatility is low, but people are buying gold. That's a conflict. So you want to pay attention when you start having too much conflict. That's when you start to see, the market doesn't like uncertainty. And usually, when you get enough uncertainty, people get careful. People start to get careful, and they start putting their money into gold. And so it's interesting to me that we have low volatility, and the best performer is the mining industry. And then right behind that is the energy industry, the alternative energy industry. Also, right there at 100, already cracked 100% year to date. So 100%. So you could have doubled your money in the in energy this year already. Let me see. Can y'all see that actually? Let me go here. So let me make it a little bigger. If I can make that bigger. Okay, so that is more. So we see, and so we see the mining industry is a $641 billion industry. Alternative energy is a $394 billion industry. So, and then telecom, number three so far for the year at 83.68%. And then telecom fiber optics, 59.88%. Computer data storage, 57.66%. Um, what we got here? Metal and mining ores, 57%. And we comparing these numbers to what the market has done so far this year. I think the market is like at 14%. So when you hear people say, I always hear people say, see, I hear so much silly shit, honestly, and it just makes me realize how much people don't know what they're talking about. At the end of the day, I'm gonna give you this and I'll give it for free. 50, 30, 40, 50% of a stock's motion, the stock's movement, up or down, is going to come from the industry that it's in and the amount of institutional support it has. And so, if you focus on stocks and leading industries with growing institutional sponsorship, you just check those boxes right there, you got a 50% chance of making money. The only thing that had the difference is the magnitude of what stocks are going to go up more. But if you focus on stocks that are leading stocks and leading industries, and they have growing institutional sponsorship, meaning what's institutional sponsorship? Well, institutional sponsorship, that's the big money. That's what really drives. Those are the whales in the market. That's not an individual. It's an institution, meaning that's the big banks. That's the pension funds. That's the that's the hedge funds. Okay, that's the private equity. That's the institutional money, the people that buy billions and billions in shares, right? So I'll give you an example of that here in a second. So, and this for all my real estate people, because I know the real estate people always feel like I'm bashing them, even though I came from the real estate game. Um, Building heavy construction is where the money been in real estate right now, right? It hasn't been in the housing; it's been in the building, the heavy construction. The new person suggestion for me over there. Okay, so what else we got on here? Retail, mail order, and direct, 50%. Building maintenance and services, 47%. Um, and then what I'm paying the most attention to is computer hardware, computer software, electric semiconductor equipment, and electric semiconductor fabric. So the semis are up 35%, 36%, and the growth in the semis. I realized the reason why I made the AI money machine is I realized how important semiconductors are to our lives. Like you guys can be watching me on you guys can be watching me on Instagram, YouTube, um, on Facebook. You can be watching me on any of these places without semiconductors. And so I just started to realize how important semiconductors are to the economy, and I decided to lock in on that and make it because the market is so big, you can watch everything. You can monitor it, and you can have a service, have these different services, and see, who's hot, who's not. But it's better to get intimate with a certain with a couple of sectors, a couple of industries, and then you pay attention to those industries, and they kind of tell you what's happening. And if you really think about the American economy, and you look at the growth in California, New York, um, Texas, Georgia, you start to see this technology that's driving the growth all over America. And really, it's not a whole lot of growth anywhere else. So that's why my focus. Somebody asked me one time, well, why are you so heavy on tech? And why are and they was talking about the trash coming in. It's like everybody needs their trash. And it's like everybody does need their trash. They do. But um, the profit margins on in waste management versus the profit margins on semiconductors is night and day. I want to say profit margin probably like 20, 30, 40% more for some companies, right? Especially for the leader. If you look at the leader in waste management, compare that to the leader in the semiconductor industry, it's not even close. So for me and everybody who's rocking with me, if you see what I see and you think that artificial intelligence is going to disrupt all these different industries and give people the ability to be more productive and to produce higher quality products for a cheaper price, then you see that the profit margins are going to be expanding, which is usually when businesses start to get old, their profit margins start to compress. We're seeing profit margins expanding at a lot of these companies, and so that's why I'm so gung ho about why people need to invest in the infrastructure, the data centers, the semiconductors, the equipment makers, the clouds, um, the switches, everything that has to go into this transformation that we need to maximize the value of artificial intelligence. I just think that that's going to be a sweet spot with a lot of places. And a lot of places make a lot of money. And to be honest with you, I made a lot of money with it already. I was able to I was able to get my account. I beat the S&P 500 by 2,000%. S&P 500 was 36, I think 36%. And y'all will see it here. And my 12-month returns was 2,163%, something like that. 2163, something like that. Better than 2,000. All right. So when we look at what's going on in this market and where the money is to be made at, you want to focus on industries that are in that top half, top 50%. So we look at these different industries and we can see let me see what's the market done. Is this gonna work on here? Oh, no, it's not gonna show y'all that. I want to show you, but let me see. Market trend, big picture. Hey, when I gotta go down this rabbit hole, but sometimes you just gotta do that, right? And we're gonna go. I want to give y'all this number because these are some important numbers, right? Um, the market indicators page. So, um, so when we look at that, can y'all see that? I hope y'all can see that. When y'all look at that, we can see the market is up 14.6% year to date, and for the S&P 500, 18.8% for the Nasdaq. And the reason when you look at tech and why I'm so tech heavy, look at what's dominating the tech industry. You got Nvidia, Microsoft, Apple, Google, Amazon, Meta, Broadcom, Tesla, Netflix, Palantir, ASML, AMD, Cisco, who is it? Micron, Shopify, AppLovin, LRCX, Pinduoduo, Qualcomm, Applied Materials, Booking, Intuitive Surgical, Intel, ARM. And what that's telling me is this market is dominated by tech. It's like tech is what is growing. If you think about it, um, right now we got sticky inflation and high unemployment. Those two don't go together. the only way that you can see that is that what is that really a sign of? Because comes from inflation comes from higher demand, higher demand um, than supply, right? If we go back to simple high school economics, it's inflation is a product of supply and demand. Now, they try to keep unemployment below a certain level, but above a certain level, because if everybody had the thinking is if everybody has money, then everybody's going to buy stuff and then drive up the price of everything. That's where inflation comes from. So if you got a situation where you got higher unemployment, but you still have an inflation, then that's telling you one thing. Somebody put it in there. It's telling you that the rich are getting richer and the rich are spending more money. The rich are spending enough money to make up for the unemployed people, and they're keeping the economy going by how much they're spending. Does that make sense? And so I say that to say this. Um, when it comes to artificial intelligence, you're gonna get down or you're gonna lay down because it's coming for your job. It's coming for everyone's job. And so you got to Um, think about it like this. I heard somebody, I heard people say, "Oh, well, if you got you got blue collar jobs that it's not going to be able to do. It's not going to be able to crawl under a house and do electric." So you telling me you think that they got robots that can defuse a bomb, but they don't got robots that can do plumbing? Does that really make sense? That don't make sense. You got come on, you smarter than that, you better than that. And I'm not trying to scare you. Maybe I am trying to scare you because I want you to understand that there's a high probability that you're going to get laid off one day in the near future, um, and you're still going to probably have bills that you need to pay. So you need to know how to make. You need a backup plan. You need to have a way to make money even you need to have a way to make money without working. You need to be able to make money even if you don't have a job. You got to be able. This is bills. You got to be able to make money. Even you got to find a way. You got to sell a product or a service. Um, I advise you to start a business selling some kind of product or service, and I advise you to invest in the technology industry. I would say 70% of 70% of Americans are underinvested in the technology industry and probably underinvested, period. And so these are the kind of companies, and it's simple, right? I teach people how to trade options. So you don't always have to have the mentality of I need to hit this stock, get it super cheap and have it go to the moon to make money. No, what options give you a chance to make really 5 to 10 times what you would make on the stock's movement. And that's why I trade options because of the flexibility and the leverage that you get from options. And so you pull up to the AI money machine, you're gonna get some of the sauce where I show you how you can use a small amount of money, how you can take a small amount of money to control a large amount of assets. And then the cooler thing about options is if you buy stock, if you buy real estate, the way you make money is by it going up, or you rent, with real estate, you usually make money by it going up. The other way you make money with real estate is by renting it out, right? You can rent out some real estate and make some money off of it, right? Well, the thing about stocks, and you combine them with options, you can do the same thing. You can buy stock and then you can rent it out the same way. You can do a lease with an option to buy on the stock with a lot less money than it would take to do it with a house, right? So that's the concept behind cover call, and I'll be teaching that in the VIP days how you do cover calls. But also, I'm gonna teach you how to do synthetic cover calls too. So this is gonna be one of those opportunities for you to learn how to generate multiple streams of income in multiple different ways. And so it's all about capitalizing on the transition to the economy, which is what we're doing. And so yeah, when we look at those industries and let's look at some stocks. Yeah, let's look at some stocks that interesting stocks today. All right, cool. who's broke out today? Oh yeah, we said nothing was breaking out today, right? So let's see what's nearest pivot. What's near the pivot point? So you see, Apple is near a pivot point today. Apple's near a pivot point. CCJ is near a pivot point. EBC is near a pivot point. JBTM, HIMS, uh, Tigo, and CrowdStrike, all near pivot points. Meaning, um, what's a pivot point? I know some people are like, well, what's a pivot point? I'm talking to pivot point is where um, when the stock gets ready to break out. So remember earlier I said you want to you want to plan your trade and then trade your plan. Your pivot point tells you where your buy zone starts. Right? So on every trade, you should have a pivot point, a profit target, and a stop loss. Every trade. Pivot point, profit target, stop loss. Before you ever get in the trade, pivot point, profit target, stop loss. You got to have those things. And you not, are you just gambling? If you don't have those things, you just crossing your fingers like an ostrich, just burying your head in the sand. You got to have a pivot point, profit target, stop loss. Okay. So let's look at some of these before let's look at some of these before I get up out of here. So we see Apple. Look at that on. So we see Apple and the last pattern. So Apple pivot point was 260. It's at 256 right now. Okay. The prior uptrend was 10%. It's in a stage one base. For the last 41 weeks, the depth of the base is 35%. So now I know y'all might not know what I'm talking about, but when we talk about charts, and I'm gonna be going through this on charts, really, you gotta know how to people give you all these different chart patterns and try to make it. It's like three chart patterns is what I pay attention to. And I'll be teaching those. I don't know if the chart patterns are in the VIP day or in one of the regular days. I'm not sure. But whatever it is, it's still I ain't even charging y'all that much. Like it's a super godfather deal of what I'm doing the VIP for. So if you want to learn how to read charts, I'm gonna sprinkle a little bit of that in there too. But it's basically three chart patterns that I pay attention to that I look at the most. I look at the cup with the handle, I look at the flat base, and I look at the double bottom of the BBL. Okay. So if you see right here, this look like a BBL or it look like some movies, right? So cup, and then another one right here. And so basically, this is when you're looking at buying a dip, and sometimes a dip don't just go straight down. Sometimes a dip kind of comes down, forms like a cup shape, right? And so when you look at it, then it comes and breaks up. It gathers. It shakes out all of the. It shakes out all of the sellers, and then it starts to build up a little momentum, and then go on another run. So what we like to see is the stock to go sideways for it to recover, go sideways for a little while, build a base, and then break out from that base, take off on a new run, take off to a new high. And so that's really what the chart. That's what charts are really. That's how you really use charts to stack the odds in your favor. And so if we look at Apple right here, Apple is getting right near its buy zone. It'll probably go sideways for a little while, consolidate. They got earnings coming in 23 days, so it'll probably consolidate. And then based on expectations for how that phone is going to do, it's going to tell you if Apple is going to pop. Now, for me, when I look at Apple, I see a company that's starting to get really mature. I am getting the new phone, and this is a way I think we have to pay attention to this, right? I was thinking about something the other day, and I said, "For I know it's anybody on here, I ain't trying to hurt nobody's feelings, but if you got more Nike shoes than Nvidia shares, you're doing it wrong. If you got more Nike shoes than Netflix shares, you're doing it wrong. So we got to start putting our money into things that increase in value and stop placing so much value on things that decrease in value. That makes sense. And I'm talking too fast. Am I talking too fast or are you listening too slow? Which one is it? All right. So look, Apple is going into a period of consolidation. It looks like, and so we'll see if how it's what is that from from the April bottom 167 to 256. That's actually a nice run, right? What is that? 256, 256. What's it? 157. That's a 63% run from the bottom. So that's a nice recovery. Nice recovery. Now, what I'm skeptical about with Apple though, and I'm waiting to see is what new product are they gonna have? And you got to do more than new product. Okay, they might get the people, I know we hear people talking about how pretty the phone is. So the colors might work for a little while, but that's more flash. I need to see something of some substance. Now, Apple will always be a category king because if you think about it, the app store. So it's not just the phone. So Apple makes money off of everybody that has to come through their app store and tear them off. And so Apple, don't get me wrong, Apple's not going. I don't think it's going to be a fast mover. I don't think it's going to be one of my fast movers for 2026, but I do expect it to be steady. And because it's going to be steady, there's certain trades that you can make off of it where you can generate a steady stream of income, right? There's a couple of different ways that you can play Apple. I think you can play Apple right now with calendar spreads. I think you can play Apple with an in money call spread. I think you can play Apple. I think you can play Apple with cover calls. I like them all three of those. I would probably wait. And I mean, we're close now, but from a technical point of view, I want to see Apple pull back to the 10-week moving average or the 40-week moving average before I will buy it for a long-term buy and hold. That's what I like to see. So I like Apple at the what's the 50? We get Apple at 234. I like Apple at 234. I get Apple at 234, and I think there'll be an opportunity to get Apple $234 sometime between uh, now and Christmas. May when I look on the daily chart, I see it. I see what looks like a flag, and I see that consolidation that looks like it could just bounce and take off. So the other way that you can play it is if it does break above two, if it does break above two, what was the pivot point in 260? Yeah, if it does break above 260, you just put a tight stop in there and see because um, honestly, you just look at the way Apple has treated its owners over the last 20 years, and it's been remarkable. They've had a remarkable run. I just think that they are lagging right now in artificial intelligence. That being said, they pick up the right companies or they get the right people over there, and things can change in an instant, right? They can catch up in an instant, and so I would never underestimate Apple. That's what I'm not going to do. So for me, Apple. So we talk about. I got a segment is buy, sell, hold, or fold. Apple's a hold for me. Apple's a hold for me. And then what else we got over here today? What about chemical? Now I'll tell you what I like about chemical. Right, Canadian owned company engaged in the exploration and refining and conversion of uranium in the U.S., Canada, and Kazakhstan. Why do I like this? Well, for starters, 30, 30, 31, 69% earnings per share growth for 2025 expected, and then following that up with 31% earnings per share, and we see a period of accelerated. We see a period of accelerated earnings per share growth when we look back over the last 5 years. When we see them, they turn from a company that was losing 25% in a year and then 30 to make 33% the next year, 88 the next year. Looked really good. Now 2024 suspect, when we see that drop off, it has to be something behind that because they're right back at you with a dollar 13, and then following that up with a dollar 49. So this is somebody who you want to keep an eye on. You look for a place. So where's the pivot point? There, the um, pivot point it's going to be right here at about $90, right there, about $90 for Chemical or CCJ. What else we got? What about Eastern Bank Share? Oh, and I'll tell you something else I like. So remember earlier I said what I said. Y'all paying attention? Y'all paying attention to what I said? I said 50% of a stock's movement is going to come from the industry it's in and the amount of institutional support that it has. It's got to have growing institutional support. So if we look, it's in the top three industry. It's in the top three industry in that mining, metals and mores, and then institutional sponsorship went from 1538 to 1562. So what is that? That's almost 30, or what is that? 24 new institutions bought into it. That's what pushed the price up. Plus, it's got a relative strength rating of 91, meaning it's outperforming 91% of stocks. If you think about it, and I didn't talk enough about that, is relative strength rating is underrated, right? We want to focus on companies that have an 80 relative strength rating, so that they're in that. I look at it kind of like in percentiles, like when your kid takes the S&T and they'll tell SAT and they'll tell you, well, he scored in the 90th percentile. That way, this company has performed in the 91st percentile, meaning it's outperformed 90% of companies over the last year or so. Okay, so CCJ, now Eastern Bayshore. Who we have here? Now, Eastern Bank is the banks in the Northeast. Northeast is known to get the money, right? And same thing, nice earnings per share growth, 47 and 26. But and the industry is not a top industry right now, though. 79. I prefer, top 50. Now, it could be top 100 if I'm looking at my Zacks list. Um, we expanded a little bit because they break out into more industry. But I like the earnings per share growth. Don't get me wrong. And what has me hesitant and what have me not looking to buy, or should have me looking for an alternative play on this, is institutional sponsorship is falling. It's falling. Institutional sponsorship has been falling for the last two consecutive quarters of decreasing institutional sponsorship sales, and then the relative strength rating is only 72. So I'm gonna back up off of it because of that. I gotta get out of here in a second though and go get my little man from school. That's why I did it at 2 o'clock, so y'all don't keep me on the phone all day long. So I gotta go get my little man. Y'all, I hope this was insightful, and I hope you learned a little bit, and I hope your interest got piqued, and you want to come to the AI Money Machine Challenge this weekend, so you can level up, so you can lock in and level up and get to this bag. Because I'm going to help you take advantage of the stock market to get your reparations and start generating multiple streams of income, so you can build generational wealth. So let me go get my plans though. I will holler at y'all later on. Until next time, y'all remember, don't be good, be great. And also, fast money in the streets, but the real money's